Good afternoon. Okay, so we have a really great session lined up here. Afterwards, we will have a very nice lunch. It's my pleasure today to introduce our Medtech SPACs panel. I believe some of these guys are up here hunting for startups. And today we have Mehta, Vice Chairman of Investment Banking at JP Morgan, moderating the session. Thank you, Rak, for joining us. Rak has 21 years of experience in financial advisory services, M&A, private and public equity and debt financings and venture capital investments. Prior to JP Morgan, Rak was with Piper Jaffray, DLJ, Baxter Healthcare. He has a BA from Syracuse University, MBA from Duke, and we have a terrific lineup of panelists. I'm going to let Rak take it over from here. Let's give them a round of applause for joining us today.
Really? Yeah. We just found out we went to Duke at the same time.
Yeah.
So good to be with you guys. We've got a great panel here. Scott told you the story about how he almost died taking Volcano public. I was on the ground when he came off that plane, and he did not look very good. So, hopefully, we don't have too many of those misadventures. So look, why don't we start with Oleg, and then just quickly go through your background and
yeah, definitely. Thanks. Well, happy to be here. I'm Oleg Grodnensky. I'm CEO and CFO of PRIVETERRA Acquisition Corp. We are 100% focused on Medtech. We went public in February this year. We have $278 million in a trust account. So we've been very busy since February. We also launched PRIVETERRA Fund, which all frankly happened at the same time. So we're kind of going 100 miles an hour at the same, in various directions. Obviously, SPAC is our priority at the moment, given how competitive the market is today. And just a way of background, I was a banker, like Rak, for about 10 years. And then I left banking in 2008 and then switched to private side and operational side. So I've kind of done almost 360 in different areas of finance and operations as well. So,
great, Josh.
Everybody, Josh DeFonzo, CEO of Lux Health Tech Acquisition Corp. Our SPAC is focused on healthcare technology, everything including medical devices, life science tools and instruments. We also look at digital health, molecular diagnostics, so not explicitly in the medtech space, although that's my background, and so there's a selection bias there. We went public in October of last year, so we're $345 million in trust. And as Oleg said, it's been exceptionally busy and active over that last 6 months. By way of background, beyond the SPAC, I'm also a venture partner at Lux Capital, CEO of a seed stage company, and am a recovering operator. So my background is actually not in venture and investment, more on the operational side of things. Most recently, I was COO of Auris Health, which we sold to Johnson & Johnson in April of 2019.
Scott Huennekens, some of you heard my background in a lot of detail this morning. I'm the chairman of Vida Flash Acquisition Corp. We're in the process of going public as a SPAC. Same focus as mentioned by Josh in their area.
Great. So Scott, let's start with you. You've obviously had a very successful career, and at this juncture, you could have done a lot of different things, or frankly, not done anything if you didn't want to. But you're clearly in the process of setting up a SPAC. Tell me that choice. Like, what attracted you to the instrument? The prospect of doing one.
Well, having almost died while you sat on the tarmac, I just wanted to avoid road shows and give people options for going public. And seriously, like the story this morning relative to Digirad and 9/11 happens. And so anyway, but in all seriousness, like thinking about what was next post CEO and being on boards and the like, raising a private equity fund and having a 10+ year commitment and partners and offices and responsibility didn't fit with what Frank Lidvack, my partner, and I wanted to do. So I think SPACs are a unique vehicle where you can kind of Uberize private equity. You can raise your fund almost by deal.
Yeah.
In the same way you would have a NetJet share or an Airbnb or any of these other vehicles, but also saw issue. I also saw this whole Medtech 3.0 transformation and a lot of disruptive technologies and opportunities here in the next 10 years that I wanted to be a part of that are going to take capital.
Yeah.
And significant amount of capitals to get those 10 times effects. So, doing that where you're raising money, I'm doing that on that side, being on boards and being an investor, but also having another option with a SPAC seemed to fit.
Great. And Josh, you made the similar choice, right? Talk to me a little bit about that, but also, and Oleg, maybe you can address this too, but this idea that you have a SPAC that coexists with a different investment vehicle, a fund. Like, tell me about the interplay between the two and how you guys think about assets for each.
Sure, go ahead. John, go ahead.
Sure. So with respect to the first part, similar to Scott, we really believe in MedTech 3.0, convergence of healthcare and technology, and with total just humble humility for the Oris experience, the board of the Lux SPAC is essentially a number of the board members from Oris Health. And we, the key differentiator there was, with every startup, there's grit and drive and determination and technology, and that's all well and good. But the one thing that was unique to Oris was we raised something on the order of $750 million. And so we saw the SPAC as a vehicle to disrupt the funding ecosystem. And so we, like businesses that as Scott was mentioning this morning, are platforms, and those are capital intensive. And so we think SPACs are a really wonderful way to finance a company that has a core business offering that is probably commercial while continuing to invest either organically or inorganically in a really meaningful pipeline. So that was and is our thesis on the SPAC side of things. And the way that we balance private investment versus SPAC, a lot of it is just a function of timing. When we talk to companies, the first thing, we never try to convince a company they ought to be public. If they're not ready to be public, it's like the SPAC is a no-go, and we're talking venture immediately. But beyond that, a lot of it just has to do with use of proceeds, and does having a public currency make sense for a company? Is it time to be public? And so we come with a menu of options, frankly, and try to fit what's best for the circumstance, rather than trying to force fit either the SPAC or just private investment.
Got it.
Right. No, I couldn't agree more. I think that it's definitely a company has to be ready to be public in order to talk to a SPAC. There's really no shortcuts. I think one of the advantages that a SPAC would offer is acceleration, because typically if you're looking at company's timeline, before going public, and we obviously had that in our fund, that you got to go do a crossover round, you got to go dance with institutions, get a discount, et cetera. So I think what happens today is that if the team is ready, and we feel that there's an opportunity to get from point A to point B much faster, I think that definitely makes sense. But at the same time, the fundamentals, they definitely need to be there. There needs to be validation of the story, et cetera. So all the things that typically you would look in the company to go public, it's just a different way. And I think, it's really about a partnership with the team. It's not that when you're talking to a SPAC, you're basically selling yourself to somebody. You're finding partners. And I think it takes time to develop a relationship with people, and it's a partnership, right? So you go from partnering up with a SPAC sponsor team, then you need to go partner up with the PIPE investors, and then ultimately market is the judge, whatever you do. So it's a team effort to get there. So I think, from our perspective, we definitely see a lot of opportunities along the way, and sometimes I fully agree with my panelists that you have to be ready to be public first off, and you have to use currency. You have to understand what it is to be public. You have to revamp the board from a private company to public, et cetera. So there's a lot of work that actually needs to happen, particularly companies that are scaling or going commercial. So it's really a working process.
Yeah. So I have a confession to make. When Scott asked me to moderate this panel, I thought about it for about 5 minutes, and I decided it was a good idea, because I was spending so much time with a lot of different private companies telling them that SPAC wasn't the answer for you. And I thought if I could come here and talk to 150 companies at once, that's killing a lot of birds with one stone. So I guess let's get back to that elementary question, right? Was you guys, and I'll take each one of you, have each one of you guys address this. As you think about the profile of what would be a good candidate for you, like what does that look like in your mind? You want to start, Oleg?
Yeah, look, I mean, I think it's definitely Medtech is it's a pretty big space in a way, right? You have a lot of different subsectors, et cetera. So I think, judging from our team's expertise, which we have two other partners. My partner Vic Malik, who's my partner at DeFonzo at PRIVETERRA, as well as our CEO chairman Bob Palmisano, who's a notorious executive, one of the few in Medtech that demonstrated successful exits as a public CEO with 5 exits. I think it's quite remarkable, particularly in various different industries, from ophthalmology to orthopedics to cardiovascular, et cetera. So I think from our perspective, obviously aesthetics also one of the areas that we have expertise as well. So I would say we're not shying away from any particular subsector. I think we have expertise and reach within those areas and knowledge of specific teams that we think are successful or will be successful. And obviously the network that helps us to expand or take a company from, let's say, about to go commercial or scaling much faster and much more successful. And I think that's where the validation comes from our investors, where they have seen our ability to do that with our team members, that helps us get there. And I think the other part you got to be thinking about is the deal expertise and ability to get things done quickly, because you have to essentially compress the process of due diligence that typically, in my shoes, when I was acquiring companies working for corporate, it would take me, 6 to 9 months, and I would have vice president of each division, preparing a Bible of stuff, pay, millions of dollars to financial accounting, et cetera. So it's a long process that today you have to essentially compress and do it very quickly. So it's really a skill set that you got to have going in. So I think, just being an operator or not having that deal support or deal traction is tough. I mean, obviously you can learn quickly, but I think it's important to have and understand what you need to do to be successful.
Yeah. Josh?
Yeah, I think for us, just more qualitatively, the ideal candidate, they're really companies, so I think the panelists may all have either differing or similar opinions about what stage a company ought to go public, but I think more thematically for us, if through a traditional IPO, because that's what we see as being probably the closest competitive channel. If a traditional IPO would not allow a company to tell the story of its full evolution, like where it expects to be in a 3 to 5 year period, I think a SPAC is advantageous. Being able to describe what development programs you will execute against, what inorganic growth strategies you have, and how that completes the picture, I think is really sort of what's ideal for us. And that's our primary sort of investment preference. Having said that, though, I think traditional IPOs are perfectly fine for those companies, but where the rubber meets the road is the ability for the partner company to be able to tell its story and sort of concretize an investment syndicate that's aligned to that 3 to 5 year arc. Like that's the most important thing. And so a lot of different things have to come together for that to make sense. But in our view, that's sort of the qualitative view for a company. Is it going to evolve from where it is today in a very planned and premeditated way that you may not be able to convey adequately through a traditional process?
Yeah. Scott, you agree?
Yeah, not a lot to add here. I think company needs to be ready to be a public company, has been said. So it's, in my mind, it's the kind of company that JP Morgan or B of A or Goldman or whatever that are the lead bankers would take public. With that kind of said, to Josh's point, I think there's opportunities for some big, disruptive technologies and companies to be created. And I think SPACs, there's an easier and better way to be able to tell some of those stories as you go out. So look, you can have some super cool neuromodulation company that's going public that has a direct analog to Nevro or Axonics or whatever, and that doesn't have to have revenue. You may have something else that doesn't have an analog and it needs to have 30 to 50 million in revenue and certain sizes of TAM. So that I don't have just like you probably don't have a set criteria for what's required public. And then, hey, it's a management team that's done this successfully, 3 times before, and you have confidence in them, and all of those elements come into play. as well. So,
Yeah.
I think a misperception that a lot of people maybe in the room and that I had is just, hey, there are all these SPACs. And so there's going to be 10 times more IPOs in medtech, life science tools. And that's just not the case. I
Yeah.
just don't.
The quality bar is high,
Yes.
no matter the case.
No matter the case,
Right.
it's the criteria aren't changing, I think, dramatically. You've got a lot of people that can invest across these SPACs. I was trying to explain to someone yesterday, it's like, you can invest, to play 7 hands, of poker, and then you don't like how one hand's going. You just pull your chips back and you only put more chips into the one that you want to stay in. So not all these SPACs are going to, fully play out, and then you got to get, as we've talked about, you've got to get the pipe investors to validate. So they can't just go give any price. You got to have a pipe that comes and validates price. So there's subtleties that aren't fully appreciated, I think, by the general population. They're getting educated as you talk to companies.
Yeah. So one common thing all of you said is that the company has to be IPO ready, right? And has to have, when you say it has to be IPO ready, what does that mean in your mind? Is it just visibility into prospects for the company going forward? Does it have to do with the financials? Has it to do with governance? What does that mean in your mind?
Well, I think it's everything.
Yeah.
What you just said. So you have to make sure you have 3 years worth of financials, and you need to make sure you have the right board, and the company and the management team is ready to be a management team of a public company. So I think it's important, and particularly as you have seen with recent SEC step to stop the wave of SPACs, which I don't know about you guys, but I'm delaying our quarter essentially because I can't get a hold of our financial consultants at the moment because everybody's very busy. So I think that from that point of view, there's obviously you also have to anticipate a lot of things that might come and protect yourself, meaning your shareholders and your base, and it's very important. So I think we're sort of in the environment where regulatory approach to this product is developing. You have to do everything by the book, meaning that you have to follow advice of your counsel as a SPAC sponsor and make sure that you don't cut corners and you do everything right. So I think that's very important for the company as well, because at the end of the day, your partners, you want to make sure you put your best foot forward, that from compliance, from governance, and all of the above has to be there. So it's very important that you're working with experienced teams that will be able to handle all that.
Yeah.
And nothing more.
Okay. So we talked a little bit about just competing against the IPO market. One thing, for everyone's benefit, I'm involved in a couple of these deals right now, but it's not just the public market that you're competing with. You're also competing with the private placement market. And we're involved in a couple of things now that, companies that got SPAC term sheets. But when we went out to validate those term sheets to the pipe market, a lot of those investors said, well, we're not certain that the value that you guys have negotiated with the SPAC is the right value for the company. And so, a really important element of the whole SPAC process, Scott alluded to it, is, look, it ends up being a 3-party negotiation, right? It's the company, it's the SPAC sponsor, and then ultimately you get the validation for the deal by going out to the pipe market. And those investors have a meaningful say in terms of setting the price. And that's another nuance you need to think about. The IPO process itself is long and cumbersome. You get certainty in a SPAC sooner in terms of what the outcome could be, but the negotiation is a little more complex because there's a third party involved in that negotiation who can help set the terms of ultimately how the transaction sort of plays out. And that's why I think what Josh was talking about, well, Oleg's talking about, this idea that they have companies that they evaluate agnostic of the instrument. What's the business need? And then if the SPAC is the right solution for it, they'll apply the SPAC capital. but if the business needs a different amount of capital or is not ready to go public yet, having the flexibility of having a private fund that can make some of these investments is also, you know, a great approach that these guys are doing. One thing that I think a lot of people don't appreciate, and it might be helpful if you guys just talk about it, is what's like a day in the life of a SPAC sponsor? Like, you know, you wake up in the morning and like, I don't think people appreciate everything that goes into what, you know, what you guys are doing behind the scenes. So maybe, Josh, you want to start?
I'm laughing because I enjoy it. I have fun every day, but I definitely bit off quite a bit. So when I joined the Lux team, we launched the SPAC, and I had a little seed stage company I did in parallel. I thought, oh, this would be pretty easy. This would be straightforward versus operating a company of like 1,800 people. And it turns out it's actually a lot of work. And we all talked about this when we had met previously. And I think just being thoughtful about how you're running the SPAC. I mean, SPACs are fairly lean, but you've got a board governance just like anything else. I've got a couple analysts on my team that help evaluate companies and opportunities, and you spend a lot of time building relationships with prospective partner companies. If you view these things as, I mean, they are transactional vehicles tactically, but if you just view them that way, I think it's really hard to differentiate yourself and stand out. And so we spend a lot of time educating and just engaging with partner companies, and that's different. I don't think either of my colleagues here are in a different boat. I think we're in the same boat. Like, there are certain SPACs that are out there that literally just like fire off LOIs all day long, and we don't ascribe to that approach. But so it's a lot of work, I think, to get out there and maintain your reputation and be discerning. We take the investment that we received in the IPO book very seriously. So we have 350 in trust, and it's our job to put that to good use. And so, I think walking into it, some people think it's a few hour a week job, and it's anything but. And it's rewarding and it's fun, but it's hard as anything else I've done.
No, I feel like I'm living Rock Mehta's life, here. In the sense of, yeah, there's all the stuff Josh said, and then, we've probably had 60 to 70 calls in the last, 6 to 7 weeks. So it's like 2 TED Talks a day, and you're late. Our objective is to do these serially. So is it 1 a year? Is it 2 a year? We'll see how the markets all play out. So you're developing relationships, like Josh said, for the 2022 deal or the 2023 deal. You're trying to see what the competitive things are that are coming that could threaten the thing that you're looking at. It's tremendously fascinating and interesting, but can also kind of get overwhelming relative to you could spend all of your time on it. You got to be discerning down to those 10 or 15 that you want to target and do the next level of work to try and move to an LOI. It's just like, Josh and Oleg have said, we're very discerning. We're all in this space. We're not financial sponsors. We're people who've operated in this market. And I think that's really important as you guys go forward to be looking at and talking with SPACs where there can be the value add of, hey, there are investors in their SPAC, there'll be investors in our SPAC that are investors in this space, which leads into credibility with those pipe investors. And you can pull those through. You can join the board of the company. Paul Palmisano has done all these things, and he goes on your board and has his network, or Josh and their team's network, or our network. That's going to add value, to you as you go forward. But you're then having to develop all those relationships of your advisors, your board, and like I said, I have a little more respect for how hard Rock works now.
Well, Scott, thanks for promoting our SPAC. I think, Bob's obviously has been very helpful to us, especially, how we look at opportunities. And, it's funny when we're going in, when we told our investors throughout the IPO process was, well, what are you guys thinking? Well, we think, we have good list of, 40, 60 names in Medtech that, we're going to target. Obviously, you can't. One of the things, you cannot talk to prospective targets before you actually close your IPO. That's one of the SEC regulations. So once you're ready to go, it's very intense. And frankly, we didn't expect the amount of, reaching in as we started. And it's just, I'm still sort of up to the 20 names of my original list, and then all the other, additional 40 that just came on top of it. So I would say it's very intense. And I think it's very important to kind of pick your horse and pick your sort of teams that you know of and where you have relationships. I think it's important to how you manage your time before you actually commit to the LOI. And I agree with my panelists that we're looking at it from a fundamental standpoint of view. So we're not just going to flip something to public and go away. Do another one. I mean, we do want to do another one, but I think from our view, we want to stay with the company long term and continue sort of all our track record that we had previously, where we want to be with those companies long term and continue to help them once they're public. Particularly given our background as Vic and I are former bankers, so we understand what Rack is going through and what he's telling us and how to read what he's telling us too. So so I think it's it's a combination of things that you have to be very precise how you spend your time, because you can talk to everybody for 2 years and not get anything done.
Yeah, and I want to underline some of that, right? Because just put yourself in these guys' shoes, right? I mean, you heard them say they're tracking 50 to 75 companies, right? And every one of those calls is probably a 90-minute call. You're probably doing 2 to 3 hours worth of work before you're actually getting on the call, so you can make the call more productive. And then when you get done with the call, there's probably another 2 or 3 hours of work thinking about it, calling other people, talking to them, doing more diligence as you sort of winnow that list down. So the velocity of discussions that these guys are having on a day-to-day basis, and that's not counting the time you're spending with your accountants, with your lawyers, with governance matters. I mean, there's a lot on their plates. So they're trying to make these decisions in an efficient way and try to be clever and thoughtful about it. One misconception that I hear a lot, and I'd love for you guys to kind of weigh in on this, is this idea that SPACs are going to value companies in a more target-friendly way. And maybe, and we talked a little bit about this idea of competing versus the IPO, competing against the private placement market. How would you guys talk to us how you think about valuation when you're approaching a target? Anyone?
Well, I think I can just say, look, if you have a lot of money and you don't care what market thinks, you can do it, right? Yeah. If you have a bunch of billionaires basically getting together and setting the value on their own, that's one way to do it, right? But not everybody is like that, right? So you have to play by the rules. So I would say that you have to make sure that the PIPE investors are there with you, and they're validating the story, and they're essentially your partners. There's definitely a certain level of negotiations, but the methodology, I think we're kind of dancing around the same issues. That there's really no, it's almost like looking at IPO and having 100% insider participation. You sort of say, well, is the market validating you, or is just investors validating you, right? So there's different ways to kind of get there, and then obviously once you're there, market ultimately the judge, and company's quarterly performance determines the fate of the business. But I think there's really nothing new out there where investors, let's say if we look back a couple of years ago, the state of markets were very different, particularly if you're looking at life sciences, not necessarily medtech, but insider participation was pretty much required for a lot of companies going public at the time. I think now it's all basically case-by-case basis, right? But at the same time, it's still present sometimes. So I think it's really, there are lots of instruments, there's lots of ways how to get from point A to point B, and I think it's all company specific, or market essentially determines sort of what our conditions are. I mean, when we were going out in February, markets were really hot, and every single investor told us, I want to be in your pipe. I think right now it's a slightly different story, but I think there's still demand for good stories.
No, I don't think value is a differentiator relative to traditional 1933 IPO or a SPAC. Look, if OrbiMed and Deerfield and Pura Vida and XYZ, the crossover investors and public investors are in our SPAC, and they're the pipe people, and they're investing in IPOs, there's no difference. They're investing in IPOs, they're investing in SPACs, they're valuing the company, and often we're sitting there working with JP Morgan as our banker, saying, what's the value of this? And, they're doing the value as an IPO, and they shouldn't be that different. So I'm on one one board where we're actually going through the process and you know, the de-SPACing, and it feels very much like the IPO, like just what's the demand out there, who are the investors you're trying to curate the pipe and who's in and build the book, and that just feels like I'm back, you know, with Rock in you know, St. Louis, listening to Eminem, as I recall.
Kansas City was,
you know, Kansas City, you know, finalizing the book at Volcano. It's not that different, and the value is what they're assigning. I think some of these SPAC values you've seen the last 6 months as things gone public was just a function of where the market was.
Yeah.
And now I think the last, you know, month, few weeks is actually probably a good, healthy thing for the market to kind of return to more traditional metrics that we're used to for medtech.
And you're seeing that happen, you know, at a breathtaking speed. You know, I mean, think about the private equity market in the 90s when sponsors would talk about getting 25% IRRs, and now sponsors talk about getting IRRs in the low double-digit, mid-teens kind of range. So that, you know, it took 20 years for that market to become more efficient, for pricing to come down. You've seen that happen much faster in the SPAC market, right? It basically happened in 3 months.
Yeah.
And so, but the underlying principles, I think, are still the same, which is, you know, SPACs are not right for every situation. I think there's an impression that, you know, these SPACs have 2 years to get de-SPACed, and therefore there's an urgency on their part. There's an urgency because people want to do a deal, but there's not the kind of urgency where these guys are going to go out and just do a stupid deal, right? And at the end of the day, these companies, when they de-SPAC, are public companies, and these guys are going to own a major portion of it. So they're riding along with you and are really taking a long-term perspective on the fundamental health of the business. And, you know, they're rational market participants in terms of how they think about value.
It's a super important point, because I don't think most people don't understand, okay, we go raise a risk capital pool, $5, $6, $7 million or whatever it is, depending on the size of the SPAC. That's the capital Frank, myself, are limited, you know, can lose. You go raise your SPAC, that's the other 200 million, 300, whatever $million. All that money in that trust, if you don't do anything in 24 months, goes back to them. The risk capital is lost. I would rather lose the risk capital of $5, $6, $7 million
Than do a stupid deal.
The partners, huh?
You'd rather lose it than lose
Than do a bad deal, because I'm going to do
You can't
3
do
or 4 other IPOs with,
Yeah.
you know, these other companies, and my reputation, or our reputations, the Lux reputation, their reputations are way more important than that risk capital I have into the deal. So pressure is not a concern relative to getting a deal. You want to do the right deals at the right price, deliver results to investors, and it's what's best for the company to be priced right and grow into, because they're going to probably need a next capital raise. It doesn't help to go public over $1 billion if you're worth $600 million. And then, you know, the stock trades down, and then you're back out trying to raise money in that next round and the like. So the same, I think, pricing discipline needs to be there in both scenarios, and it's important.
Yep.
And I think a few months ago, it was the case, maybe 6 months ago, there was some daylight between valuations you were seeing in SPACs at large versus what you might see through other channels. But I actually don't think that is a good thing. In our particular case, our SPAC, the way we're structured is, Scott described the risk capital, which we have a pool, and that's how it got started. But we have an FPA, or a forward purchase agreement, into the pipe. So we maintain discipline not only in principle, but also financially, because the risk capital we put into the IPO, we have about double the amount as a minimum threshold into the pipe. And so, you know, ultimately we need to be successful not only with the initial transaction, but with the pipe follow-on piece. And when the SPAC market was disrupted several weeks ago, everybody asked, like, well, what's changing? And it's like, there's a focus on valuations. And our view is, like, there always should have been a focus on valuations, because you, again, can write an LOI that's got a really frothy valuation to satisfy existing board members, only to go out and road test in the pipe market. Not much different than you would when you do a road show for a traditional IPO and find out that, you know, the valuation that was pegged is somewhat divorced from reality, which is not a good thing. Like, why spend the resources to do that? We think it's better to try to optimize for all stakeholders, not upfront valuation that you're trying to jam, because you're just going to not like what you find on the other side of the process.
Yeah.
Right.
That, by the way, what Josh was just talking about and going out and talking to pipe investors, one thing you guys should keep in mind, I've had a number of conversations with public, pipe investors, and oftentimes the sponsor behind the SPAC has a huge impact in terms of how they think about valuation, because they're essentially relying on the diligence of, people like the panel in front of you, and the fact that a bunch of these guys have name recognition with these investors, they've run operating businesses before, they've made money for investors before, that brings a lot of credibility to that transaction. And a lot of those pipe investors are relying on the diligence that these guys do to form a view themselves on valuation. So I think as you evaluate SPACs, think about who the sponsors are, what their biographies are, what's the network that they're bringing, what's the pattern recognition that they're bringing, because really you're signing up for a long-term partnership with these guys. So being thoughtful about who your partners are is always, very, very important.
Yeah, it's important. I would say that it's important to know who the investors are in the IPO and how many sort of specialized, not necessarily agnostic hedge funds you have, but really, who's there. And I think the other part that we're not talking about here is the fact that with a SPAC, you know exactly what the valuation is versus an IPO. We have to price discovery, negotiation, et cetera. You really don't know where you're actually going to end up. With a SPAC, it's more or less, where you are. Of course, there are, in some deals, there are redemptions, but that's what, which adds to your sort of work that once you, first you go to the LOI, from the LOI, you go towards the announcement of the deal, you get pipe validation, and then once you announce the deal until closing, you basically have to cater to every single investor you have with the management team for between 3 and 4 months, and making sure that they don't redeem and they like the story. So it's really, think of it in a way that it's actually it's a pretty intensive process for you, but you know what you're getting for it. So I think there are pros and cons, I think, between the two. But again, at the end of the day, it's how you get from point A to point B. So
yeah, Josh, let's start with you. And I'd like everyone to address this if you can, but we talked about one of the misconceptions about SPACs, that people think that they're not as thoughtful about value. What else would you say, when people call you and say, well, we think we're the perfect SPAC candidate or target, like what are the misconceptions?
Yeah, I'd say the top 2 or 3. One is valuation arbitrage. The second one, a misconception, is it's the forward-looking story. And I tell everybody, we love a really good non-fictional forward-looking story. We don't like fiction so much. So yeah, I think that is a benefit, but it is not the only benefit. If it's just like, hey, I'm not really sure how the next 24 months are going to go, but then months 36 and 48 are going to be great. I just counsel to people, you are a public company, so you are on the shot clock, and yes, you have consolidated investors around your book, your IPO book, but at the end of the day, you do have to provide guidance and everything else. Yeah. So that's probably number 2. And then I think the third piece is the speed, right? It's faster, and arguably maybe by a couple of months, but the work and the readiness is still the same, right? It's still the same. So I'd say those are probably the 3 biggest misconceptions. And
Oleg and Scott, you agree?
yeah, look, we obviously like science, and we like science projects, but I think from the SPAC standpoint, it has to be more than a science project. So, I think it's important that, and again, it's like I've been through different crises as since 2000, 2008, and I've seen how it happened, specifically in biotech and other areas where, you sort of go out, 5 years out, and then you're sort of discounting back to today, and you sort of, and I see some of these patterns again and again. This is like the 3rd time already. So, and it's interesting. So, sometimes you can get away with it, sometimes you don't, but at the end of the day, it's, if you look at sort of how these SPACs are traded that were announced at the top of the market, everybody's pretty much around their initial price, right? So I think it really investors. This is a product that has changed. I first got familiar with it back in early 2000s at my last investment banking job, where we're actually the leader at the time. It was a very different technology. I think it changed a lot today. It got much better. And I think in our economic recovery and sort of where we're going today with all the trillions that we're about to spend, I mean, this is a perfect instrument that essentially democratizes access to teams outside of a club investors and spreading it more and more out there. So I think it's along the same lines of what's happening in other spaces today.
Great. We have about 10 minutes, so we'll open it up for questions that people have. But anything else you guys want to hit on?
No, I just building on what Oleg said. I agree with that democratization aspect here, and I think one of the things from a misperception is some of the benefits. I mean, I look at the benefits as being, certainty of timing, certainty of price, that you can curate your SPAC and your investors a little more actively. And then I think the underappreciated part, Rock, you mentioned, was the team and what the value that the SPAC can actually bring to the table. I think a misperception is the SPAC is just capital and they're one size fits all, or they're all kind of the same. And it's no, there's investors in our trust who, there's our reputations, there's, a curated and populated pipe that's waiting as well. There's our operational experience, our network that's a value add. And having been involved in 5 IPOs, and you transition from VC boards to governance boards, and you go through all that process. I was very fortunate. I had people like Ron Machikuri at St. Jude, or Alex Luciano from Nuvasiv, Kieran Galley had built ResMed, guys who built $100 million to $1 billion plus things. We're kind of off the shelf, solutions to that kind of package as you go forward, in addition to those other benefits. So I think there's a reasonable, position that, half of all future IPOs could be SPACs. I think more operator led SPACs with domain experience based upon some of those benefits. And the benefits, Rock, that we provide you. You get to take the SPAC public, and then you get to do the M&A all within a short period of time. So we double your fees.
I like it when you guys think about making me money. I really like that. So thank you for doing that.
Yeah.
Well,
No, I think we should limit to 2%.
2%.
5.5%. Yeah.
We'll talk about that later at the bar. So for that. Happy to answer. Why don't we open it up? If people have questions, we can have these guys address it.
Hi there. So 2 questions. One is, what are the typical milestones you're looking at in terms of FDA approvals and commercial milestones? And the second is, from a company point of view, what things lend a company more to further rounds of institutional VC money versus a SPAC?
Well, I think maybe I can set you guys up, but I think, from a simple rule of thumb is, at the end, whether you go public through an IPO or you go public through a SPAC, you are a public company. So the really important milestone is, or the evaluation is, can you be a public company, right? And that, keep in mind that while the SPAC market is evolving, the regular way IPO market is also evolving, right? And so what public investors are willing to accept as a public company is the most important criteria, I would say. Wouldn't you agree?
Agreed.
Yeah.
I think you want to make sure you're aligned with your board in terms of where you're going, and with a SPAC at the same time. That's the only way it works. Because if you have a board that doesn't think SPAC is the right way because it's maybe not prestigious enough, then maybe you'll be wasting your time and the SPAC's time. So I think those are the kind of things you kind of want to think through before you start the process. Make sure you have a board support to go that direction, because that's important.
I don't want to speak for these guys, but as it relates to us, I mean, we don't have interest in development risk, clinical risk, or regulatory risk. You have had to have cleared those hurdles, and we'd prefer that you have a commercialization ramp, but you're at least commercializing, can show your value proposition. Back to my talk earlier, the juice has to be worth the squeeze. Big TAMs, differentiated platforms, management teams that have done it before are all the preference. You're not going to necessarily get all of those, but that's a pretty good criteria list.
And your other question about VC versus SPAC, I mean, keep in mind that all of these guys have SPACs that are in the range of $200 to $300 million roughly, right? And remember, you're also layering on additional pipe capital on top of that. So you really need to think about what the funding need is, right? And there's a lot of different companies here who are raising capital who don't need $500 million, right? So I think thinking through that aspect of it is also really important.
Yeah, so we would be looking for things that have an enterprise value 500 million to $1.5 billion, which we're a little bit smaller in size of our projected 150, 175 out of a pipe here at 200. That's kind of what most medtech IPOs, life science diagnostic tools, are raising in an IPO and need, for their general runway.
You can always go up, you can't go
Yeah.
down.
Yeah.
That's the
Yeah,
rule.
it's easier.
Yeah,
to go up.
and I'm just speaking frankly, so we're like Lux is 345, we think the minimum pipe of 400. So juxtaposed to Scott's, like our EVs are minimum 1.25 billion to 5 billion, right? So that's a different quantum of capital for different type of opportunity. And there's no right or wrong. It's just a different thesis with a different profile, different stage.
Yeah,
But I would say both of those, I completely agree with what Scott said. I mean, we as a preference, you may find other sponsors who feel differently, wouldn't entertain regulatory risk, clinical risk, fundamental and basic technology risk.
Right. Yeah, no, from our standpoint as well, I think we want to understand exactly how you're going to get from one stage of development to the next. So if we can assess and understand, obviously in medtech, it's, I would say, rather easier and more feasible than you go to biotech when you're sort of developing something for the next 10, 15 years, especially today where companies going out in phase 1 or even preclinical. So I think it's a different nature of the industry that helps you get there. But of course, everybody, I agree with my panelists, we're sort of thinking the same lines.
Any other questions?
Revenue, good rap, not fiction, can execute on it. Need $200 million. Why do I need you? I mean, can I go right to the rock? So,
Yeah.
why would I evaluate, if my board is saying, go IPO, what would I say to them to consider, you three guys as an alternative?
So I think my view, I think both share it, is you should meet. I would encourage you, if you are entertaining being a public company, you ought to talk to JP Morgan, you ought to talk to a couple of SPACs. And I think a lot of it comes down to what Scott was saying is there a differentiator? So first and foremost, you're going to want alignment with the SPAC sponsors, culturally, vision, mission. Second, to Scott's point, they should add some very material value to you in some way, right? So we tried to be thoughtful. I think each of the panelists up here as well tried to be thoughtful of who's on the board and what value do they add to you, either in terms of know-how, capability, network. Like as an example, one of our board members is Bob Carey, who's lead director for Tenet Healthcare. There's value there in the sense that there's network and access, et cetera. And then I think last but not least, there are transactional or tactical things that I think are beneficial about SPACs, like the price discovery, like understanding where you are sooner, having a little bit more of a deterministic process. Those are all benefits. Now, there are pros and cons to both. I won't sit up here and say it should be all SPAC all the time. I don't think any of us said that. But
Yeah.
I think also you can,
No, go ahead.
I think you can also add that you can skip a step, for instance, before doing a crossover, IPO, and a follow, and you can do it all at once. Which helps you as a management to execute and actually focus on business than talking to investors, taking a lot of your time. It's a time-intensive process. I mean, especially if you go through 3 of those things, right? So I think it's just easier in a way.
Yeah, back to what I said, Ken. I mean, it's deal certainty and deal timing can be faster. My 2 examples is like Digirad, 9/11 happened. We'd have SPAC'd, we'd have been done, we'd have had LOI signed, wouldn't have been in a situation, where we're laying people off and have to, cut things back and, put the business back too much. You never know what's going to happen. The other IPO with Volcano, we had, I think it was 12 to 14 on the cover. Interest rates went up, Ben Bernanke, oil prices went from $40 to $80. We had 8 straight red days of a negative, 100. People were saying to us, why are you out here? The IPO market is closed. We priced the deal at 8. A year later, we're doing a follow-on offering at 19 or 20. That situation would have been avoided, with the fact those things happen. So a SPAC's ability to get you the right investors in a pipe, the right, board, the right governance, the right, with deal certainty and the capital, is an option, as Josh said, to JP Morgan.
I think it's also an allocation issue, right? So for instance, if you're a hot company and, typically in the IPO, Fidelities of the world get very little. So if you're offering more, they'll take more. And therefore you can get away on the value point as well. So, but it's, it's a fine line. It's all market dependent, but at the same time, there are advantages there as well.
Yeah, the last thing would be, Josh mentioned it earlier, you can tell your story more as well. In an IPO, you're limited relative to your projections. Now, that you saw some, fiction, in the electric car vehicles and then getting to, revenue rates that no companies had reached in history, and they were all promising to do that. That's not, I think, beneficial. But the ability, as he talked about, organic, inorganic platform, building out in a big area like what you guys do, I think would be very, very interesting to public investors and how you could use large amounts of capital to achieve.
I mean, it's that plus selecting your investors in the pipe market. So aligning the people liking your story and aligning the book. That's probably the most above and beyond the network and the team and all of those benefits. I think forward-looking story, aligning an investor base to it and aligning them to you in the public market can set you up for success. That's our view.
Yeah. So with that, I think we're out of time, so I'll wrap it up. I'd like to thank Scott, Josh, and Oleg for participating in the panel today. I'll leave you with this one thought, which is I think, there's a tendency to always over-index on things. And just like a few months ago when everyone thought the SPAC was the answer to every problem, and now there's a narrative out there that the SPAC market is dead, neither of those is true. It's a very, very specialized type of instrument. It works in a lot of ways, in a lot of different circumstances. It's got to be right for the company. It's got to be right for the SPAC. And it's a viable alternative for certain companies, and it should be something that you have in your solution set as you think about financing a company over time. So with that, thanks for your participation and your attention.